The numbers are staggering. As 2025 ends, China's trade surplus is set to top $1 trillion, a record-shattering figure. This means China sells far more to the world than it buys, a sign of its manufacturing dominance and global economic power. The surplus has become a flashpoint in international relations, fueling debates in Washington, Brussels, and Tokyo. For years, experts thought China's surplus would shrink as its economy matured and its people spent more. Instead, the opposite happened. The surplus ballooned, especially after the pandemic, defying predictions and trade wars alike. How did China pull this off? The story starts with its 2001 entry into the World Trade Organization. That move unlocked China's manufacturing potential, turning it into the world's factory for everything from toys to iPhones. Each year, its exports grew in value and complexity, making the surplus a symbol of China's economic miracle. But for trading partners, it's a source of anxiety, lost jobs, unfair competition, and a growing sense of imbalance. Today, the surplus is more than an economic issue. It's a geopolitical one, giving Beijing financial leverage and shaping global supply chains. Understanding how this surplus grew, why efforts to curb it failed, and what it means for the future is crucial. The puzzle stretches from factory floors in Guangzhou to boardrooms in Silicon Valley and government offices worldwide. China's trade surplus isn't just a number, it's a story of power, resilience, and a world economy in flux. The question now, can anyone rebalance the scales? The answer will shape the next era of global trade. And the world is watching. Why does China export so much? It starts with scale. China's massive, efficient workforce and world-class logistics move goods from factory to market at unmatched speed and cost. This infrastructure gives China a core advantage in global trade. But it's not just about size. China has moved up the value chain, becoming a leader in high-tech manufacturing. Your phone, laptop, solar panels, even electric cars, many are made in China or rely on Chinese components. The government's strategic support, subsidies, tax breaks, and cheap loans has fueled rapid growth in key sectors like electric vehicles and telecom. This state-led approach lets Chinese firms out-innovate and undercut global rivals. Chinese manufacturers are deeply embedded in global supply chains, making it hard for multinationals to move production elsewhere. The ecosystem of suppliers, skilled labor, and logistics is too concentrated to easily replicate. Even as political tensions rise, the world remains dependent on Chinese manufacturing. This stickiness ensures a steady, massive flow of exports. China's export machine is built for resilience, and the world can't easily unplug. That's why the surplus keeps growing, and why it's so hard to reverse. China's trade surplus isn't just about exports. It's also about low imports. Chinese households save more and spend less, partly due to a weak social safety net. This means less demand for imported goods. Currency policy also plays a role. A managed yuan keeps exports cheap and imports expensive. China's economic model favors investment and production over consumption, slowing progress toward a more balanced economy. The government's dual circulation strategy aims for self-sufficiency, reducing reliance on foreign technology and imports. As China makes more at home, its need for imports shrinks. The result, a persistent, widening trade gap. The US launched a trade war in 2018, slapping tariffs on Chinese goods to shrink the trade deficit. But the tariffs were bilateral. They only hit goods shipped directly from China to the US. Chinese exporters simply shifted focus to other markets in Asia, Latin America, and beyond. For many products, there were no real alternatives to Chinese manufacturing, so US companies kept importing, often passing higher costs to consumers. The tariffs acted more like a tax on Americans than a fix for the trade imbalance. They didn't address China's high savings, industrial policy, or cost advantages. The root causes of the surplus remained untouched. China's export machine adapted, found new markets, and the surplus kept growing. The trade war was a surface-level solution to a deep, structural problem. The imbalance endured. Faced with tariffs, Chinese companies got creative. They rerouted exports through countries like Vietnam or Mexico, where goods were repackaged and shipped to the US, dodging tariffs, a practice called transshipment. This made it hard for customs to track origins and blunted the tariff's impact. Southeast Asian exports to the US surged, but much of it was just Chinese goods with new labels. Chinese firms also built factories in third countries, producing tariff-free goods for the US market. This adaptation embedded Chinese capital and influence across the developing world. The trade war made global supply chains more complex, not less. Targeting one country with sanctions in a connected world just shifted the problem. The world's reliance on Chinese production didn't shrink, it just changed addresses. The core imbalance stayed. China's export dominance proved remarkably resilient. Is China's trade model sustainable? It's powered decades of growth and lifted millions from poverty, but the lopsided surplus is fueling global frustration. Trading partners complain about unfair competition, subsidies, and market barriers. More countries are considering tariffs and trade barriers, risking a fragmented global economy. Internally, China's export reliance makes it vulnerable to global downturns. Domestic imbalances, like a fragile property sector and rising debt, are growing. Leaders know they must boost domestic spending, but change is slow and difficult. If China doesn't adapt, it risks a global backlash and instability. Genuine reforms, opening markets, floating the yuan, encouraging consumption, could rebalance growth. The path China chooses will shape the world's economic future. China's trillion-dollar surplus has global consequences. For the US and Europe, it means persistent deficits, lost manufacturing, and political backlash. For developing nations, China's demand for raw materials boosts their economies, but cheap Chinese goods stifle their own industries. Many risk becoming mere commodity suppliers, unable to build diversified economies. The surplus gives China huge financial power. It invests export earnings in US bonds, making it a top American creditor. This creates a strange interdependence. The US relies on Chinese investment, while China gains leverage. The imbalance distorts the world economy, making it more vulnerable to shocks. One country saves and produces, others borrow and consume. Economists warn, this isn't sustainable. Fixing the imbalance is essential for global stability. China's surplus is the biggest challenge. As 2025 ends, the trillion-dollar surplus poses a trillion-dollar question: what's next? Trade wars and diplomatic pressure haven't worked. China's export-driven model endures. One future: rising protectionism and trade blocs, splitting the world into rival camps and reversing globalization. Another: China, pressured by internal challenges, pivots to a consumption-driven economy, boosting imports and shrinking the surplus. This rebalancing is slow and uncertain. The path forward is unclear. China is too big to ignore, too integrated to contain. Fixing the imbalance will require tough choices in Beijing, Washington, and beyond. It's not just about tariffs. It's about rethinking global trade for a new era. The next chapter of China's surplus will shape the world's economic landscape, and everyone has a stake in how the story unfolds.